Good morning, everyone. I'm honored to share the stage this morning with four incredible founders to kick off this year's Venture Atlanta. I would love to start by having each of you kind of share one-liner about what your company does, and then also your most recent fundraising round. So I'll start with you, Tony.
Good morning, everybody. My name's Tony Summerville. I'm the founder and executive chairman of Fleetio, which is a fleet management software platform. So all of our customers around the globe have a fleet of vehicles and equipment that they use our software to manage. We've raised about $175 million to date, with our most recent fundraising round happening back in May of this year, which was about $150 million.
Very nice.
All right. Hey, everyone. I'm Emily Morris. I'm the founder and CEO of Emrgy. We are a climate tech startup decarbonizing the water sector using innovative, low-impact hydroelectric technology that we manufacture and then develop projects using that technology. We've raised a little over $30 million to date, with our most recent round earlier this year at around $18 million.
Hello, good morning. Yuri Frayman, CEO of Cast AI. We are a Kubernetes cloud-native automation platform. The idea behind the company is to manage all of the application resources for the infrastructure in order to run application effectively, where we derive a significant savings in the cloud bill.
Good morning. I'm Tyler Scriven, co-founder and CEO of Saltbox. Since we're here in Atlanta, I'll describe Saltbox as the MailChimp of e-commerce logistics. We are building a end-to-end logistics enablement ecosystem that is purpose-built for small businesses, and our offerings run from software to logistics services to a national network of co-warehousing facilities.
Amazing, thank you. So I'm going to start with Emily and Tony, because you guys have some similarities to your stories. One is that your rounds were both preempted by existing investors, or by an investor in some cases. How did you guys think through when that happened? Do you go to market? Do you take it and run, especially in a very challenging market? So can you tell us a little bit about the advantages and disadvantages of when you went through that process?
Go first.
All right, I'll start. So our round, I guess, all of us entrepreneurs in the room have heard the term always be raising and always, be pitching to the investors. Well, I think in our case, I took that advice, but perhaps didn't take the advice of always be fully prepared to be raising. And so, while you think investor intros sometimes may go nowhere or may snowball into something more, in our case, things snowballed a lot faster than we were perhaps prepared for. And so it was great to see, or great to get a term sheet in, and founders obviously love term sheets, but we weren't necessarily prepared to go to market yet after receiving that. And so in our case, it really wasn't as ideal in some ways, because we ended up going out to market, and 2 more term sheets later did not end up with the investor that preempted. And so I think while that was perhaps a bit of a roundabout way to get to our Series A, what ended up happening is that preempted investor actually did help set the terms for the overall round and set some of the economics that went all the way through to the final term sheet that we ended up closing the round with. And so I guess I would say that while we should always be raising, we should most importantly be prepared for that, because it's not always that preemptive investor that ends up being the best fit for the business.
And before we go to you, what would you say was the most important thing that you weren't prepared for that you should have been? What aspect of it? Like a data room, or what was it?
Yeah, not so much materials, because of course we're all preparing materials all the time. It was more around having a really thought through plan of how we were going to, who we wanted in the round, what financial partners we wanted in the round, and how we wanted to construct the capital raise overall, to the point where the preempted investor was a fairly unique investor for us, and understanding how that was going to fit with our existing ecosystem and shareholder base was challenging, and how to bring a syndicate of investors around that ultimately led us to realize that wasn't the syndicate that was going to be the best fit for the business. But, you know, in any case, being prepared with not just materials and data rooms, but with your vision in mind of what that next round looks like, who's a part of it, and what you're going to achieve with it, I think is the most important. And so, you know, being caught on your heels to go to market when you don't have that in mind yet is not always ideal.
Okay, and Tony, tell us a little bit about your experience.
Yeah, so the kind of quick background was we didn't raise any institutional capital for well into the business, and so that first institutional capital raise happened in 2020 from a group called Elephant out of Boston and New York. That was a pretty competitive process. I ran a process, and we got a lot of offers, and selected them after an enormous amount of due diligence and you know, hoping to pick a great investor. That turned out to be true over the last 3+ years. It's just been an incredible relationship at the board level, and you know, just the ways that they've been able to help the business continue to thrive. And so leading up to this year, 2023, I spent a lot of time with the larger sort of growth equity and even like PE style firms. And there was a lot of interest in doing something. A lot of them were doing a ton of research on Fleetio and really wanting and hoping to invest. And so at the beginning of the year, started talking through kind of the plans to run another process. And our existing investors had seen the business from the firsthand view of what we've been able to do and with them over the last 3 years, and made a compelling offer to preempt it. And really the pros of that were, one, we knew we had a great relationship with them, and to maintain the continuity of the board and just the way that we've been operating was certainly positive, just because we've had such a positive experience with them. And there's always a huge risk when you bring on new investors, new personalities, new folks that are entering your cap table and really going to have a lot of influence, at the very least, over the business. And so it's a huge decision. And then, for us too, we're very aligned on the strategy of the business. I think, as you get into the later, larger fundraising, our firms that, are putting a lot of capital into a business, there's oftentimes a lot of desire for those firms to invest in additional like M&A or sort of buying other businesses. We definitely want to become more acquisitive as a company, but we are laser focused on continuing to grow organically. And so having that alignment at the board level and with our existing investors was critical, because I think that's not a good situation to be in if you don't have full alignment on like what the strategy and sort of capital allocation should be. And ultimately too, raising from existing investors is not near as much of a distraction as it can be for going out and running a real process and raising from existing or new investors, which is going to take a lot of the exec team is going to burn a lot of calories trying to kind of like get a round closed, and that makes the entire exec team, for the most part, have to not keep as close an eye on the business, and so the ability to raise from existing investors kind of circumvents that. But the biggest downside is like you're not going to market. You don't really know if you're going to get a market price for the value of the business and the rest of the terms. And so that's the only sort of potential negative. But in our case, we've got what we felt like was an incredible offer and ended up going in that direction.
Now, on the topic of existing investors, I know, Tyler, your last round, I believe, was co-led by an existing and a new investor. And you, in an article, mentioned like you attribute your relationship with your existing investors to a large part of the success to raising. How do you think through maintaining those great relationships, even tactically? How often are you sending out investor updates? What are the things that you're doing to nurture that relationship?
Yeah, it's a great question. I just realized, Marie, that I forgot to answer the question about the capital raise. So just quickly, we've raised a total of $56 million of venture capital. Our last round was $30 million. In addition to that, we've also raised about $170 million of real estate-focused capital, which is not on our balance sheet, but nonetheless, money that had to go be raised in a way. To answer your question, I will admit I'm actually pretty bad about investor updates. So if my investors in the room, forgive me. However, I am extremely transparent in those relationships. I try to, engage them as friends and confidants, and the reality is that many of them over the years have become friends. I try to think about our relationship as not being centered around, the investor founder framework, but rather as two people who independently, are very focused on achieving success together and building a business. And that works well for me. I think that turns into a much more fluid and kind of authentic form of engaging with our board members. So.
I'd love to open that up. Yuri, any tips on how do you nurture relationships with existing investors?
So it's, part of it, you have to be blessed by God, right? I mean this sincerely. But truthfully, you have to evaluate the investor the same way you would evaluate hiring CMO. I mean, they are part of your organization, whether you like it or not, right? They're not only they are part of your investor, they are on your board. So the most important for me is to build the rapport with the investor, knowingly that they're brilliantly smart individuals, but they are not totally swimming inside your company. So it's important to build that relationship and see where it goes. In my experience, I had to say no multiple times. It was painful. I had to explain to my board why I'm saying no. I'm old enough and went through 6 exits, so I had many different boards, and I know at least know what I'm looking for. So bottom line is has to be a co-founder like. I don't need someone who is going to come every 3 months and play smart. I want somebody who's going to come, roll up their sleeves, and work sideline with me. Otherwise, why are you investing money? Why are you investing if you're not going to really roll up your sleeves and work with founders? Don't look to do anything other than that. So to me, that's important. And I also didn't hear the question. So initially, CAST, we self-funded ourselves. No investor would believe us that what we are set out to do was the right thing, which is another element that investors are good when they see things are working, when you fall into the metric. So we self-funded ourselves, and then we got lucky where we met Quota Capital, which really believed in the founders. We were pre-revenue company, and they led our Series A. So again, I spent time with Bobby Itzani, who is my board member and my advisor and my consigliere. I go to him all the time, but we have a very personal relationship, very personal, right? That's what you need. You want to, I treat them just like an employee.
Now, another similarity in your stories is you're both, Emily and Tony, solo founders, which I know a lot of investors prefer to invest in a co-founding team. So how were those conversations? How did you overcome some of those objections when you were fundraising?
Go ahead.
Yes, solo founder. I think it's every circumstance is unique, so it's hard to give somewhat generic advice. But I mean, for my story, it worked out really well. I mean, this was when I started the business. It was like 2011, so it was a while ago, and the venture community, particularly in the Southeast, was a lot different back then. I was lucky I could build a lot of the software myself and kind of get it off the ground, and then by the time we actually started really raising money or seeking additional funding from even just angel investors, we had a really compelling story to tell and like real revenue and real we had a real business at that point. So there was never a lot of like, well, you're a solo founder, there's a big risk there. By the time we were ever truly fundraising, and I think looking back, if I could go back and do it all over again, I would have absolutely loved to have a co-founder. It was definitely harder and much more of a grind and struggle to build something. It was just me for a year. I didn't hire the first employee for about a year in, and then it was a small or slower and took a lot longer to build something. But in the grand scheme of things, maintained a lot more equity in the business, and so it worked out well in the long run.
Yeah, I would agree with Tony. I've actually never experienced the pushback or objection to being a solo founder. Where I disagree, though, is if I look back, I'm not sure I would have changed anything about that. Now, I think part of that is because I'm a first-time founder and a first-time entrepreneur, and I wouldn't necessarily know what to look for in a co-founder. Instead, I was able to surround myself with mentors and subject matter experts and individuals working in roles that were really critical to building the credibility of the company, the credibility of our go-to-market plan, and the technical expertise that we needed. Although, looking back over the organization and our growth, we've had some very distinct chapters of that growth, and the expertise that we needed and leadership we needed along the way has absolutely evolved from day one. And so I'm not really sure how I would think about going back and having a co-founder that would be, continuous along the way. But definitely for my next startup, I would say I know what to look for in a co-founder. I think the criteria for what would help me propel as a leader is a lot more clear. And so perhaps next time around, I'll go the co-founder route.
That's a good point. So Tyler, I know on our prep call, we talked a little bit about the importance of being in the right mind space when you go to fundraise. Can you kind of share a little bit about how you got in the right mind space to prepare you for the raise?
Sure. We raised our Series B in November of 2022, so a year ago. And if you recall, it was, that year was kind of, the onset of the dark days for venture. I think when I went out to market initially, I was really mentally bogged down by, the headlines and just kind of the sentiment that was, in the room, so to say, about the challenge ahead. And I think that really took a toll on me and how I showed up, early in the process. But with the help of people who cared about, the outcome, I came to realize that ultimately, this is not about the environment. It's, it's about you as a founder. And someone said something really interesting to me, which stuck with me, which is that the real challenge in raising capital, no matter what you're doing, whether you're starting a venture-backed company or something else, is to convince the person in front of you that you're going to be successful with or without them, and that the only decision is, do they want to be successful too? And I think, when you embrace that mindset, it becomes a lot easier. But that mindset can be challenging to settle into when the world around you is sharing a pessimistic message.
Now, we have 2 Atlanta founders, one Birmingham and one Miami. I'm in Miami as well. But, we all are based in what, especially pre-pandemic, would have been considered outside of a major tech hub. Silver lining of the pandemic was that seemed to go away and, level some of the playing fields. How do you guys feel? And Yuri, did you see, especially being in Miami, a difference in fundraising environment pre and post-pandemic?
No, I think, we picked Miami long before Miami was Miami. So, it's a great place to live and great place to build a company. But we have no obstacles, right? Sometimes you hear you should have an office in Menlo Park, and I say, why? Why? I mean, there's no reason, right? So basically, there was no real obstacles in our journey. And as you could see, that environment in Florida is growing, and you have great talent. A lot of people would like to move from the California to Miami. We had a number of employees that made that transition. So absolutely no obstacles.
And so, Tony, you recently made the decision to step out of the CEO role. You are now chairman of the board. How difficult was that decision? What went through your thought process?
It's definitely a tough and relatively time-consuming decision. Something that I thought about for really like the last couple of years. As mentioned, I'm a solo founder. I've been building the company for a long time. As CEO, my job has changed tremendously over the years, going from an employee of one, myself, to now we're nearly 250 or so employees. And I've had to evolve and change a lot over the years. I think what I realize and recognize is the things that make me a good entrepreneur and a good founder, and really the passions that I have around product and technology and even marketing and sort of building, seeing a vision come to fruition. Those skill sets are certainly still important, but building a scale business and scaling it to 500 thousands of employees, it takes a different set of skills to be the CEO. And I think where I started to realize is there's, I think, an opportunity for myself to take a step back out of the day-to-day. I mean, after 12 years, I was exhausted, quite frankly. But
Rightfully so.
also, I knew that the business was to a point where there was, people out there that could, I think, run it better than me. And I think sometimes as a founder, you can hold the business back at a certain size and scale where the things that got you there won't take you to the next level. And so for me, it was a wonderful decision from a both personal standpoint, but I think it also is good for the business as well.
So Emily, you operate in a highly regulated environment. How did that affect your fundraising?
It affected it greatly. Originally we had planned to raise our Series A in 2020, and once the pandemic hit and we ended up having a bit of natural runway extension from that, our business has a lot of travel, it has there's some capital intensivity to it that could be scaled back a bit to extend runway from 2020. What we ultimately decided to do was to be very deliberate in waiting until the next presidential administration. Being in climate tech and foreseeing a change in administration coming, we had hypotheses that was going to open up both market accelerators for climate tech, including tax credits and grant funding and things like that, as well as private sector participation in that, which has absolutely been beyond what we expected. There's been new climate tech funds announced monthly since the presidential administration change in 21. And that was a huge tailwind to being able to put together an exciting round. And so some of the funds that are invested in our Series A weren't really even investing pre-2020. And then in addition, being able to take advantage of so many of those market accelerators like tax credits, like federal funding to accelerate not just R&D, but now projects into the field for new energy transition technologies has been huge for us. So while it was, definitely a conservative time in 2020 and even into 2021 as we started to think about the round, and then the round, as I mentioned earlier, was a bit elongated based on really thinking through who the right syndicate for that round was. It was absolutely the right decision for the company, and it absolutely led to aligned investors who all have the same goal in mind. That has allowed us to have really transparent, really clear, really close relationships with them, both within shareholder communications as well as in the boardroom. And while it is perhaps a bit probably strange looking in from the investor community of timing things really related to either political cycles or regulatory conditions, but in our case, it absolutely served both the company and our existing shareholder base well.
So I want to have each of you kind of answer this question, but a lot of the advice around fundraising is geared towards founders. What advice would you want to give to investors in the room when looking at a founder? Like, what do you wish they would have done when you were fundraising? I'll start with you, Tyler.
That's an interesting one. Yeah, I think one of the things that's always been most confusing to me about raising capital is the idea that you just meet an investor and then, shortly thereafter, they write you a big check and join your board, and I think that's odd. It doesn't make any sense to me. And so, what the advice I would give would be to say that if you are genuinely interested in partnering with me and our team, then I think the first step in that process is making an effort that's really focused on getting to know us as people, rather than jumping right into the let's do the investor pitch date thing, because it's just not going to happen, and I think that is probably by and large true for many of the most promising and or successful founders.
All right, Yuri?
Well, venture world is no different than our world. They have number of business development people who are going out to the market looking for great companies. So whether it's 21, 22, or 23, or 24, there's always capital for great companies. So how do you really display yourself as that great company? It takes a team, it takes an ability to communicate your value across different sector, and then command a financial statement that will show how those metrics fits into the valuation. The key word here is valuation, right? That you would like to receive for the equity and the investment. So it's important to take those calls, right? You have to be smart about whether this particular fund is looking to extract information just for the purposes, somebody need to fill out a spreadsheet, or it's a really interesting fund and they have done interesting investments because this is a public information. Of course, you don't have an idea what they are currently investing or what they're looking at, but at least you could track what the past is. So going out there, speaking to as many funds, learn the type of questions they're asking, right? Have an ability not to get offended by a tough interviewer, right? I mean, just learn from that, because whether we like it or not, they're going through hundreds of companies, so they hear 100 presentations. So they derive their knowledge from whatever those founders are communicating to them. So then they compile that knowledge and they then basically bring it over to you, which is very similarly to what happens when you're going to market and the customer says, do you have this? Write it down, because you don't, but you say, I will deliver it, right? So it's a very, very similar approach. I mean, I think that's the approach I took with Cast. We were successful. We were successful because, one, our company, dramatically accelerated in our go-to-market strategy. And, in this particular case, we had number of people who went after us, and my job and my team's job was to ensure who do we want as a partner. But to really underscore, there's plenty of money. It's the valuation. Right? I mean, in 21 and 20, they were paying some crazy stuff. Now it's more aligned. But it doesn't mean that you cannot get this valuation if you can properly communicate and if you have a proper partners around you.
Yeah, as I reflect on our fundraising all around so far, I would say there's a strong correlation between the best investors we have on our cap table and the easiest money to raise, because they were investors that got what we were doing, that wanted to be part of the team and the success, and they had capital to be able to deploy. And when I think about on the converse, those conversations, those hours of diligence that we poured in trying to get people over the finish line and just couldn't get them there, when I look back, I don't know why we spent the time on that. I think that if I had advice for investors, it would be to be, as Tyler mentioned, genuine. I think that's a great word for it. If you're genuinely interested, you get what the company's doing, you want to be a part of that success, then I think it's a natural fit. And I think sometimes when you find yourself trying so hard to fit it in the box, ask if that really is what you should be spending the time doing, because ultimately, when everybody is satisfied and thriving together, that's when the company is going to continue to grow.
Tony, take us home.
Yeah, my quick advice is more just a reminder that your reputation matters tremendously. The investor community is very small and tight-knit. You all know each other, and so do us founders and people that are building the next wave of startup companies. There's a lot of us that all will definitely talk about the things that are positive about certain investors, and certainly will remember and bring up and tell others about the negative things too. So your reputation matters.
Amazing. All right, please help me thank them.